Hello there, VV Nation, and welcome to this very special presentation on the truth chart. You know, with all the geopolitical noise that's dominated the headlines, from ongoing conflicts abroad to even trade tensions and political uncertainty here at home, these issues have stirred emotions for sure, rattled some markets, sent prices swinging from fear to relief in a matter of days right now, it seems. But let's be clear, none of it changes the real driver of long-term market direction. Corporate earnings does. And so inflation, interest rates, global unrest, they may grab the spotlight from time to time, and inflation and interest rates are the enemies of earnings. But earnings are the engines, ultimately, that drive stock prices higher and higher and higher over time. And that's the truth. So let me walk you around a little bit and show you more about what we call the truth chart and provide a little clarity, hopefully, on the current economic condition like you've never seen it before. So let's jump in and take a look. All right, so as we mentioned, earnings are the engine that drives stock prices higher and higher, but earnings has a couple of enemies by way of inflation and interest. The sum of the parts here are what drive market performance around the globe, either higher or lower. And so we're going to jump in, take a look at the dynamics, the interplay of these three things, show you around, and give you some what to look out for on a current basis. So we mentioned rising earnings are the engine that drives stock prices higher and higher. Let me prove it to you. What we're going to do is go right into VectorVest and take a peek. All right, so first thing I'm going to do, I'll go right into graphs. We're going to take a look at this little stock called Micron. There's a number of stocks we could use, but this is a beautiful depiction of the kinds of stocks that VectorVest would prefer you buy when it's time to buy them. That's the other important factor. More on that later. But what we have is beautiful price direction, and that's a result of beautiful earnings direction. You can see they almost move in unison together, and that is for a reason. Have you heard the expression, money goes where money grows? Yeah, like I'm not going to put my money into a broken model. I'm going to put my hard-earned nest egg into companies that are growing their earnings quarter after quarter after quarter, year after year after year. The ones that have a working model. And the stronger the performance, the better, right? And so we want acceleration with earnings ultimately. And so when we look down here, it's important for you to know a couple of things. One, with EPS, that is known as the bottom line, right? Are we making more money in the future or not? Now, at VectorVest, we produce a one-year calendar leading earnings per share. So it's not so much how well companies are doing today, like with, let's take Amazon yesterday. The nice thing about the Amazon report was not only did they knock the cover off the ball, they expect that to continue. Investors like that. Money goes where money grows. Other companies that have done that recently would be like GM or Carpenter Tech and many, many others. But having said that, the perfect scenario is finding companies who consistently grow their earnings quarter after quarter after quarter, year after year after year, and are likely to continue to do so for the next year, right? And so we look at up to 12 years of trailing data, and we also look at the upcoming year ends for the next 2 years, and we crunch that into a formula producing that one-year calendar lead. And so it's important to understand that as we look back here for any data point, earnings at those times were also showing to continue to rise for the year into the future from there, right? And that drum just keeps on beating louder and louder and louder to the point where we look down at earnings growth expressed as a percentage, it's accelerating, not decelerating like many companies are experiencing in the stock market today. So let's take a look at that. Next graph I want to show you is going to be of the S&P 500. And one way to get there, you may not be acutely aware at least, you can go to viewers, we can go to watch list viewer, go to S&P watch list and the 500. When we get here, I can come to the bottom and there's an average row. I can right click and view the watch list average graph. And when I do that, I can drag back, for example, over a period of time. And we can see that, yes, here again, earnings, and again, this is a forward 1-year lead of earnings per share, is the engine that is ultimately going to lead prices higher and higher and higher again. What we can also see is that we're beginning to slow down here a little bit. And even over time, the acceleration is no longer putting down the gas pedal quite as firmly, right? We're decelerating. Now, let's not misconstrue the message. Everything is still in pretty good shape here, right? It's when we are no longer rising on that forward basis, but indeed falling, that things become a lot more harmful. Okay, so deceleration is one thing, going downward is a whole different scenario. So having said that, hopefully this gives you at least some comfort in knowing that there is room to remain somewhat optimistic here. But as we alluded to, earnings has a couple of enemies. And those enemies seemingly are starting to come back into play or view here again. And I think that's what's causing some of the consternation in the stock market right now, where we're having these violent swings from one week to the next, or a few days to a few days, it seems. Now, when we look up, we can see the markets really have been slowing down here quite a bit over the last, say, month and a half or so. All right, well, what we want to do is go back and let's talk about the enemies, and then we'll put all of it together in a complete picture. All right, so here are again the enemies, inflation and interest. They're known as the enemies really for a couple of prevailing reasons. They both directly raise costs and ultimately reduce demand, squeezing profit margins from both ends, at least potentially. So in terms of inflation or higher costs, when inflation rises, the cost of raw materials goes up, labor, transportation, all of them are on the increase. And companies can only pass on so many of those things before it costs the demand. The demand drops. And so ultimately profit margins shrink, right? Higher borrowing costs are a result of higher interest rates, right? And so as central banks raise interest rates, for example, to fight inflation or those higher costs, it becomes more expensive for companies to borrow money for expansion, R&D, AI investments, refinancing existing debt, and ultimately, as far as the consumer, potentially higher mortgage rates to buy a new home, car loans, credit card interest rates rise. It's not a certainty, but it's a likely scenario. And so that reduces disposable income, which weakens sales and ultimately revenue growth at the corporate level, right? And so that's why they're the enemies. And so we're in this interesting situation right now where earnings have decelerated a bit. And if you're paying attention to the Fed meeting this week, they're starting to sound a little bit less accommodative, right? So we were on this mission to go through a further sequence of lowering interest rates to help spur the economy and get that growth cooking again, right? But, inflation is starting to tick up just a little bit. Most experts agree. And even we can't see a lot of the data anymore these days. PCE report didn't come out today, right? But, that's the general consensus. And also, the jobs market, with the data that we do get that is fully revised, we can see, and even this week, we've seen some headlines, right, where major companies, big names, are beginning to lay off some folks. And it would be nice to see what even the rationale behind that is, whether it's more AI driven or, reductions to improve the bottom line, those kinds of things. So, the Fed's in a little bit of a pickle here, where we've got a crumbling job market, but at the same time, inflation is starting to maybe move the other way again. And so that puts them in a more difficult situation. And that's why there's a lot of dissension in that group right now, it sounds like. So all things being said here, the picture has become a little bit more on the cloudier side of things again. No time to panic. Hopefully I'm setting your mind at least a little bit at ease right now, right? It's not panic time. It's time to start sitting up and taking note, okay? So with that, what I'm going to do is refer you to a couple of essays. They're written by our founder, so there's no better place than to hear it right from the horse's mouth. Right, the truth chart back on March 21st, 2003 in the VectorVest views, and then the follow-up with the earnings indicator March 28th, 2003. There's been other essays as well, but that's a great place to start. Those were the first two in which the truth chart was written about. So here is the truth chart. Now, the first thing to pick out is there are 8 cases. 1, 2, 3, 4, 5, 6, 7, 8. On the comments over on the right, you can see that there are 4 bull market scenarios, and there are 4 bear market scenarios, cases 5 through 8. If I draw your attention back towards the second column, that's the earnings column. The common denominator for bull market scenarios are rising earnings. Earnings are up. The common denominator for bear market scenarios are earnings are down, right? So if you want to know when the next official bear market has begun, because it likely already has. Remember, perception is reality. And Wall Street looks at this stuff too, because they want to put their money where money grows as well, right? And so often there's a confirmed down call before you even get into an actual qualified bear market. A lot of times the pain has already begun, okay, because they're looking ahead as well. So we need to be cognizant of that right now with the picture getting a little bit more cloudy, So with that being said, we also currently then you might want to know where do we stand. It's interesting because we've landed back in this case 1 bull market scenario. Now cases don't have to move sequentially, and this is a sort of perfect example of that because normally what you're dealing with in a capitalist-driven economy is kind of boom and bust, right? Creative destruction and all this. But you go from bull markets to bear markets and it cycles. And generally you land in a case 1 coming out of a bear market because the Fed is trying to lower interest rates to spur the economy again. Okay. So what's happening here is we've kind of backdoored into that. The economy has remained somewhat strong, stronger than even some people believe, right? But at the same time, some of these things are taking a little bit of a toll, and we've got some deceleration. So what they would like to do for this reason, among others, it seems, is to lower interest rates for, I guess, a myriad of reasons at this point. But one is to try to get the economy humming again, and that's the primary, right? And so that is how we've kind of landed back here, which is great should a soft landing be achieved. Now, if you Google soft landing, you'll see that they are not easily achieved. And it's because the Fed is balancing 2 things that are largely incompatible, jobs and mild inflation, or that's the goal, 2%, right? So we're running hot. If we were running the levels on inflation 10 years ago that we're running right now, there would be a lot more talk about it. But since you're coming off of extraordinarily high inflation, which does have a compounding effect, right? So I'm not, foolish enough not to know that. But, comparatively, things have cooled quite a bit. And they're right to say that, but it's still very elevated compared to what we would prefer, okay? Now, I don't want to get into arguments of should it be 3% now and all that. That's not their dual mandate right now, okay? So when we talk about these things, they've done a pretty good job getting us to where we are. Now the question is going to become, and there'll be a lot of eyes on it, where are we going from here? So unfortunately, in this past Fed meeting, not a lot of light was really shed on that. In fact, it's more just kind of, I don't know, your guess is as good as mine kind of thing. So, there seems to be some pretty wide disparity in terms of what that group wants to do. Anything from raising to lowering, and by a pretty good clip lowering interest rates is what I believe I heard. So, all that being said, look, let's take a step back. It's fun to look at all the different gyrations and possibilities of what happens with interest and inflation. Ultimately, they're the enemies. And ultimately, at some stage, they're going to impact the bottom line. And they're either going to spur it, or they're going to kill it. And that's been the way it's been for the duration of time. So what we need to pay the most attention to is that earnings trend. And the earnings trend is very important. I want to make sure that I show the climate graph. So one of the things I want to do is come over here and go to market climate. And on the top, you're going to have a 50-day moving average of EPS, or the bottom line, on the S&P 500. And on the bottom, you're going to have its earnings trend. And so we're taking into account a lot of factors. And to be quite honest, I don't know all the math either, right? A lot of this is proprietary, and a lot of it remains so that somewhere in China you don't have VectorVest, right? so it's kept secret from even us for a reason. The people who need to know, to keep the business running. So on the bottom, we take all the earnings data we look at and we interpolate that into a trend indicator, ETI. When it's above 1, earnings trend is up. When it's below 1, earnings trend is down. When it's above 1 and falling like it is right now, that just tells you what I've already told you, that earnings trend is decelerating a bit. It's still at a pretty comfortable level, and it looks like we're still a decent ways away from potentially, or even at all, crossing below 1. In fact, if we look back, we can see we kind of flirted with that. I don't know how many folks remember sort of the oil crisis of 2022 and hot inflation and everything. That really deteriorated corporate earnings growth on a forward basis, right? So it's good that they got all that back in check. We leveled out before we went into bear market territory, like we did even in the Black Swan event with COVID, okay? And so far, ever since COVID, things have been pretty good overall. So again, it's not panic time. I want to keep saying that because I'm going to try to alleviate some of your probably hyper concern about all the YouTube videos and everything you're watching these days. But having said that, we do need to remain grounded in the facts and realize that the deceleration is real. Okay. Now, why that's important, if we take away sort of black swan anomalies and oil crunches and things like that, and we get back to like real important things like a financial crisis and things of that nature. When earnings dip below 1, you got on the ETI, you got to be real careful because you could be heading into an official bull market scenario for a while in that case, right? So that's what we want to be on the lookout for. Again, the good news, there's still a pretty good distance to get there, and going from where it is to below 1 isn't going to happen overnight. But do remember, everybody's looking at the same stuff we are, and hopefully you're getting at least a picture that that's maybe why we're slowing down here on the stock market a little bit, because everybody's trying to work this out. Okay, where are we really heading right now? Okay, so hopefully as we get deeper into the tech with AI and all this stuff, it is as great as everybody says, and the clouds depart and the sky is open, and earnings starts cooking again and all that stuff. But we don't want to get too pie in the sky about that. We want to see it to believe it, right? So that's where we stand here. So it's better than most people probably feared when you started watching this video. Now, the next thing that we want to, just kind of be aware of is what we were talking about, where, let's see how the Fed begins to continue to react. But most importantly, just keep our eye on this ETI. Okay, now, because perception is reality, and because it's very difficult to get into everybody's mind, that we're all looking at the same thing. When we start to get confirmed down calls, you do not want to be ignoring them. So what we're going to be talking about here next is really just A, hopefully you've ascertained the earnings trends, the most important thing. B, we can see at least the acceleration is now decelerating, right? So C, when we get information from VectorVest telling us to be defensive, we probably should be so, because other folks are probably going to start being more defensive right now as well than they have been. Okay, so what we're going to do is go into the market timing graph, because the 30,000 foot view gives us that big picture. Now, in the big picture, the earnings, inflation, and interest rates, those are important variables for what's likely to happen over time. You can still have corrections even and significant ups and downs within that scenario, right? So you need to be on guard on market corrections all the time. But when things are weakening, even more so, right? So what we want to do is come in here and go to the market timing graph, and we want to say, okay, where are we? And what do I look for? So a confirmed down are these red marks. And you say, well, the last one, the market just reversed and went higher. So my goodness, when that comes in again, I'm just going to ignore it, right? Last two, market just rallied from there. I'm going to give you a couple of things to combat that idea with. One, if your luck is as good as mine, the next time you decide to ignore one, not that I did, I'm just talking about my luck, it's going to turn out to be one of these, which is going to make you wish you listened to it. Look, when you get a confirmed down, we can have one of two conversations. We can have a conversation of, hey, Steve, we got a C down. I got defensive, and I had to take those defensive actions right back off because things got better again. What gives? I don't mind those conversations because you did the right thing. What I mind are the conversations of, Steve, we got a confirmed down about 3 months ago, and now I'm 15 or 20% underwater. What do I do? Right? Those are not fun conversations. So what you want to do is listen. You want to take the defensive actions. If you don't need them anymore, get rid of them. Whether that's tightening stops, moving towards cash, trimming the fat, buying contra ETFs, using options as income or a hedge, anything about a current situation in VectorVest that tells you to become more defensive. And we might get a confirmed down call this next week, which is why we're trying to tie all of this together for you and give you a better picture of where you stand, okay? So we had a primary wave downshift yesterday. And so a week from then would be the potential confirmed down, because when we come in here, if I go to our MTI layout, we'll see the buy-sell ratio is already below 1. So we no longer have broad market support right now. It's that bifurcation that Powell was talking about with, I think it was the consumer in the Fed meeting, but really you could say this is a bifurcated stock market because you've got all the strong, healthy AI plays, and I'm not talking about the crazy ones, and then you've got sort of everyone else. It's kind of bifurcated in that way in the stock market, right? But buy-sell ratio is telling you that. I mean, broadly the markets are in a lot of pain right now. When we look at the MTI. And you might say, well, Steve, I'm just going to keep buying the bifurcation. Well, no, because at some point, they're going to follow suit. The MTI has gone below 1. Last time we saw that, what happened? Okay. Looking at, it's like being a football coach. What we're doing is looking at game film, right? So when we get a confirmed down, you better listen, because if you didn't listen last time, look what happened. Right? Last time, particularly, the MTI went below 1. Okay? Well, what about all this stuff over here? I don't care, because this is the one you want to avoid. That might be the next one. You don't know. I don't know. Nobody knows. I do know that it's more likely now than it was over the last two. I do know that. Okay? So, ultimately, just don't fall asleep at the wheel. Listen to the guidance. If we tell you to get more defensive, get more defensive. If you have to take those defensive actions off, take them off. Good for us, right? But not listening is not an option, because if you're not careful, things get really bad, really nasty, really fast. Okay? All right. Really, that's the bulk of what I wanted to talk about today. I'm not going to go through signals and all that, because how we configure them and everything, because that's what our time in the market guy is going to do for you today. I just wanted to send the general message. This is what we're dealing with. It's not as bad or as good as some people think. Somewhere in the middle. Hopefully the earnings season will turn out better than even everybody's wildest imagination. Skies will part, sky is blue, things are good again, right? But until then, let's exercise a little bit of caution. And so thank you everyone for being here. We've gone through the tactical, so all I got to do is say, see you soon. Come back to VectorVest University. Here's where you get the truth. And we can help separate fact from fiction for you and help you know what to look for and ultimately what to do. Get a C down next week, get defensive. Otherwise, you're probably going to wish you did. We'll see you soon, guys. Good luck.